G'day guys, Seeney here, and welcome to another episode on the Australian Wealth channel. And in this episode, we're going to be talking about the stock market and why it's gone a little bit crazy. So thank you guys so much for watching. Please make sure you like and subscribe. It really helps to get these videos out to more people. So in this video, we're going to be talking about the stock market over in the US. And things have started to get a little bit crazy over there in regards to stocks. Now, some of you might have noticed that some stocks have done really well and some stocks have done really poorly. Now, the big question is why? Why is it that companies like Google and Apple and Amazon, all of these companies have continued to do really well, but we've seen other companies such as Corsair Gaming, Tattooed Chef, have started to decline from their recent highs, and we're not really seeing that all kind of work together as the stock market often does. Now, what I wanted to do is show you guys a little bit of a chart here. So this is research from a company called Yardeni. So they have research basically tracking what the forward PE is of companies in the S&P 500, 400, and 600. And what we've seen very recently is a bit of a divergence. And this divergence is really interesting for a number of reasons because it continues to grow. Now, if we look very closely at this chart, what we'll see is that the large caps have continued to perform quite well. They have a forward PE of around 22. Okay, so based on the chart in the last few years, it seems quite expensive. It's not the most expensive that we've seen it though. And if we go on and we look at the S&P 400, the mid-cap stocks, what we've seen is that has come down quite dramatically compared to the large caps. And then if we look again, even further at the S&P 600 small caps, that has declined even more. We're seeing a forward PE of about 16. So this is really interesting. What does this tell us? We're starting to see this divergence. And I think this is because people are starting to get a little bit scared of what's happening. The Delta variant has started to come back and started to spread amongst the population a bit more. We've recently received research from Israel, who have one of the highest vaccinated populations in the world, that the protection against the Delta variant, the vaccines that they're using is about 39%. It's obviously stopping a lot of the hospitalizations, but it's still spreading. So the vaccines that we have aren't quite as effective against this new strain as they were against the initial strain. We're going to need a booster shot of some sort. So what the market is doing is there's a little bit of concern, and what we've seen is they've moved into companies that are a little bit more profitable regardless of what is happening in the economic environment. So we've seen Google, Netflix, companies like this have absolutely boomed during the pandemic. And what we've seen during the pandemic is companies like Carnival have been absolutely crushed. And we have seen that recently. Carnival, I recently sold out of at about $28 a share. We saw it rise to 31. And since it got up to about that mark, it's come down dramatically. I think it's sitting around like $21, $22 a share. And it's because of this uncertainty around the Delta variant. We're not actually sure what it's going to do. So people have moved into companies that are considered safer. So what that means is that if this doesn't end up being as bad as what people think it is, then there's a lot of opportunity in these small cap and mid cap stocks to make some money, because the market has basically taken a risk off approach. While they're invested in equities still, they've kind of sold out of a lot of those companies that don't have as much of a proven track record, that are a bit smaller, and they've moved into these larger companies that do have a proven track record. And we saw through the pandemic, like Facebook and Google, all these companies are still making bank. There's nothing that's going to stop them from making money, I think, at this point, outside of like a regulatory thing. So, maybe this is the time to be the contrarian. While everyone is moving into these large cap stocks, maybe there's some deals. And that's pretty much what I look at doing when I'm investing. Where are the deals in the market? Where is the opportunity to pick up companies on the cheap? So I'm actually looking at some of these companies at the moment. Tattooed Chef is a big one that I continue to add to. I have a position that's worth about $75,000 at this point, and I'm continuing to add to that position. And I believe there might be some other great opportunities in this small cap space. These are companies that are under $10 billion, which, sounds like a lot of money, but in the market, like a $5 billion company, that's small time compared to things like Apple and Amazon, that are bumping to and, on the way to $3 trillion, which is just crazy money. So I'd be really keen to hear what your thoughts are about this particular thing that I've seen in the market. Do you think that the large caps are going to continue to rise? Is it a bad time to be buying small caps, a good time? Be really keen to hear your thoughts in the comments. So thank you guys so much for watching. Please make sure you like and subscribe to the channel. It really helps to get these videos out to more people. So thanks again so much for watching, and we'll see you later.